a global mandate. We can invest anywhere in the world, anywhere, any market cap. We're very concentrated, and our goal really is to find 10 to 15 of the world's most competitively advantaged businesses that can compound at high rates over time, invest in them, and then leave them alone to make lots of money over time. That's our job, and that's what we're actively engaged in doing right now. And the framework we use is in large part based on the work I did at Morningstar and the concept of economic moats and reinvesting capital at high rates of return, and that's what I want to talk about today. So the basic foundation of thinking about economic moats and competitive advantage is that, shocker, capitalism works, and that capital seeks the highest returns possible. If a company is making a lot of money, others will seek to compete with it. That's, intuitively makes sense. If I wrote each of you a $50 million VC check and said, go start a business, you would probably try to do something profitable. If you are smart, you probably would not start airlines. I hope. High profits attract competition. I mean, as surely as night follows day. So intuitively, this makes sense. Empirically, it makes sense as well. If you go back over time and look at, say, take T1, companies in the highest decile of returns on capital, then roll the clock forward 10, 15 years and look at that cohort of companies, most will have lower levels of profitability. Most will have lower returns on capital as their returns on capital have drifted down to some mean as competition has come in. Of course, there is a minority of businesses where that's not the case. So, most businesses, you see high returns on capital decrease over time as competition comes in. However, there is a very small minority of businesses that enjoy many years of high returns on capital. They essentially beat the odds. They defy economic gravity. And the question simply becomes, how? And in my view, it's because they've created structural advantages, economic moats, a way of insulating themselves, buffering themselves against the competition that enables them to maintain supernormal returns on capital longer than academic theory and the averages would suggest. Because absent a moat, competition destroys excess returns. Period, end, full stop. Any highly profitable business that is easy to compete with, you will see that come down over time. Very common in the fashion industry, very common, say, in, if you guys remember back, NVIDIA and what was the other big graphics company, chip company? They would swap market shares like every 6 months. What had the best chip? Oh, no, I've got the best chip. And there's no moat there. The moat was just, what do I got that's great today? And then you got a lot of smart engineers at the other place trying to make the next best thing. So the basics of moats are that they're structural and sustainable qualities that are inherent to the business. A moat is part and parcel of the business that you're looking at. It's not a hot product. We all probably remember the Krispy Kreme debacle. They taste good, but sugar is not a moat. Heelys, anybody remember Heelys? Remember those little shoes with a wheel in the heel? That was an $800 million company at one point. I kid you, yes, I am, as Dave Barry would say, I am not making this up. People were valuing Heelys as if it had a moat. Aside from the massive product liability issues, once basically schools started banning them. And so that's a problem if your target audience of 12-year-olds can't buy your product anymore. And so that business went to hell pretty fast. It's not just a cool piece of technology. We talked about NVIDIA and the graphics companies a moment ago. Remember iOmega? Remember that was going to be the thing. It's just a cool piece of technology. And frankly, any cool piece of technology can be replicated by other smart engineers, unless there's some switching cost, some lock-in effect that occurs, or an industry standard is created. But anything that one smart bunch of guys can develop, there's probably another smart bunch of guys somewhere else trying to make it even better. And of course, it's not the biggest market share. You will often hear companies talk about, we're the biggest, we're going for market share. Let's think about GM, let's think about Compaq. It didn't work out so well. Big is not a moat. In fact, small is often a better moat than big. Moats generally manifest themselves in pricing power. A company that can't raise prices is unlikely to have a strong moat. And in fact, if you invest, this is a test often that businesses are losing competitive advantage. If you hear a company say, well, you have a company who typically raises prices 2, 3, 4% every year. They're able to kind of keep pricing power moving up. And then one year, suddenly they don't. They say, well, the economy's tough, or we want to take it easy on the customers this year. That's a load of crap. It means that something has changed in that industry. There's a competitor out there. There is some event going on that you may not be aware of that's causing them to lose that pricing power. Because if you can take price, you will take price as a business. And so if companies that lose that pricing power, that's usually the first sign that their moat is eroding. So what I want to do next is talk about the 4 kinds of moats that I identified when we were at Morningstar and that I still think make sense today. The way we identified these was by going back about, would have been later, about 50 years of CompuStat data. And it was pretty simple, just looking at businesses that had maintained returns on capital above cost of capital for 15 years plus. It's not a huge data set. And then you basically say, what are the common characteristics of these businesses? What are the similarities of these businesses? And that's where we kind of teased out these 4 categories. And they've proven to work out pretty well. These are what we introduced the Moat ratings at Morningstar in about 01. And so now we've had about 12, 15, 13 years. And the businesses we initially identified as being wide moat businesses that fell into these buckets have maintained higher returns on capital than their peers. So the empirical results seem to bear out the theory. First kind of intangible asset is a brand. And a brand is valuable if it either increases your willingness to pay or lowers your search costs. And this is really important. It's not just that it's well known. Because you think of, like, say, Sony. We've all heard of Sony, right? Sony is often ranked as one of the 20 most valuable brands on the planet by the Business Week brand week thingy that happens every year. But let me just do a quick survey in this room. How many of you would pay 20% more for a Sony DVD player? One hand? Any hands?
Maybe 15 years ago, 20 years ago.
Maybe 15 years ago, that's exactly it. And like right now, you do see like the Sony Bravia TVs getting a little bit of a price premium over others because it's newer. DVDs were newer. But consumer electronics is fast cycle stuff, right? What's new today is old next week. And so the fact that Sony is well known and we've heard a lot about it does not contribute one bit to its competitive advantage. In fact, I would argue Sony could probably save a heck of a lot of money by not advertising, or advertising very little. On Michigan Ave in Chicago, where I work, they have this super expensive flagship store with all kinds of cool stuff you can play with, and I'm sure they're paying God knows what in rent. Useless, because that brand doesn't change your behavior. By contrast, let's look at Tiffany. Tiffany will charge you 20% more for the exact same diamond that you can buy from Blue Nile or Zales or Helzberg or whoever you want. 20% is the value of that pale blue box. I can guarantee you the cardboard ain't that expensive, okay? But you know, as the giver of a diamond, that you'll probably get a bigger smile off the recipient if it's in a Tiffany box than if it's not in a Tiffany box. So they can charge it. And so that brand has value, right? That brand increases your willingness to pay. And there's value there. You also have brands that lower search costs. So think about Coca-Cola or Wrigley Gum. You don't pay a lot more for Coke versus Pepsi, but you know you like Coke, so you go there. You like Heinz, so you grab it off the shelf because you don't want to sit there and compare ketchup prices for 20 minutes before buying the ketchup. It's $3. My kids like ketchup. Let's go get the ketchup. We go through ketchup in vats at my house. I have twin 7-year-olds, and I think ketchup is like our 5th food group. It's ridiculous. So brands, again, a brand changes consumer behavior by increasing the willingness to pay or reducing the search costs, then it has value. Just being well known doesn't mean anything at all. Patents, obviously a patent is a legal monopoly, but they are subject to expiration, challenge, and piracy. And so you want to be very careful of a business. You see this a lot in like specialty pharmaceuticals, where you have one asset, one drug driving all of your economic value. That patent gets challenged, you're dead. And last time I checked, patent lawyers drive really nice cars. And there's a reason for that, which is that patents are valuable to challenge. And so if they can be challenged, they will be challenged. So when you want to rely on patents as a moat when you have a portfolio of them, that it's hard to invalidate one or the other. Think of Qualcomm, think of ARM Holdings, where there's this huge portfolio of patents. And then finally, licenses and approvals. So you have a license to do something that is not many people can do, or an approval, that is a pretty solid economic moat. Casinos, not easy to get a casino license. You have 6 of them in Macau, That's it. They ain't giving out anymore. Landfills. No one likes to live near a landfill. So municipalities don't give out tons of landfill licenses because then nobody wants to live there. That reduces the tax base. So once you have a landfill or a gravel pit, you probably aren't going to get a whole lot more of them. Aircraft parts are the same thing, have to be FAA certified, and that's a huge moat in the aircraft parts industry. Most aircraft parts are sole source. They have one manufacturer who makes them, and so they get about a 40% margin on aftermarket. It's a beautiful business. If you're selling a brand, if you're a company, here's what you want to look for when you're looking at brand-based companies. Brands are valuable if they deliver a consistent or aspirational experience. Now, consistency lowers search costs and drives loyalty. So what you don't want to do is change the damn product. That's the stupidest thing possible. Remember New Coke? Idiotic. Schlitz. Schlitz used to be the second highest selling beer in the US, most volume in the US. Now, not so much, right? And the reason was they changed the way it was made. They changed the taste of Schlitz. Why would you do this? Recently I thought there was something like I think I was with the Heinz, or there was actually a ketchup that was going to lower the amount of sugar content. They were going to change the recipe. And you just go, stop. If people are buying this, why change it? Aspiration, by contrast, increases willingness to pay. So what you want to do is create scarcity and exclusivity. Very interesting example, Tiffany stores. Now, Tiffany is unique in that we think of it as a very expensive brand, but over 40% of their revenue comes from stuff that sells for under $200. Weird, right? You wouldn't think about that. And it's brilliant. They're one of the only companies that they can hit volume and hit high price. But here's how they do it. One of the ways they do it, by maintaining the brand. You would think that the stuff that drives 40% of your sales, that'd be at the front of the store, right? You want people to get easy access to that. No. Go into a Tiffany store. The cheap stuff is at the back. So the expensive stuff, the stuff that costs more than a Tesla, that's sitting in the front of the store because that keeps the value of the brand up. That maintains an aura of exclusivity and scarcity. And so they keep the brand value up. Or Patek Philippe. Very expensive watch brand. The slogan, which I love, you don't own a Patek Philippe, you take care of it for the next generation. What a great image, right, for those of us who can afford $50,000 watches. But it maintains that scarcity and exclusivity value. And again, you have to look at, if you're looking at brand-based companies, aspirations differ. So you want to think about companies that can adapt. A great example is Jack Daniels, owned by Brown-Forman. These are two different Jack Daniels ads. I'm going to do the translations based on what I've been told. I don't speak Russian or Chinese. So this says, "Happy birthday, Mr. Jack." And if you can see it, it's the same image we have of Jack Daniels here. The frontier, the cowboy, old school. And in Russia, that works. Because a lot of Russians own dachas. They like to get out of the city and get back to kind of their sort of Slavic roots. Now compare that with this. Jack Daniels ad in China. You're in a very high-end bar, very urban, very smooth, very cool. And I've gotten this translated, but I may have I see a few folks here who might speak. You want to translate that for me?
So it simply means confidence is not in your mouth, but from other people's eyes.
Confidence is not out of your mouth, but comes from other people's eyes. In other words, confidence is how people see you. Right? Totally different, right? Because imagine in China if you had this ad that basically was like, you should go back to the village you came from. That's going to sell a premium spirit, right? So again, but here you see this adaptation. That's what you want to see in a brand-based company. Second kind of economic moat, switching costs. Very simple. Does the cost of switching to a competing product outweigh the benefits? What you want to do is look for companies that integrate with the customer's business. So the upfront costs of implementation get huge payback from renewals. Think about an Oracle database, for example. If you're P&G, if you're Citigroup and you're running on an Oracle database, ripping that out is virtually impossible. It's not impossible, but it's really, 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 really hard. If you showed up today, if Google, for example, built an amazing database and showed up to P&G and said, we've got Google Base, and it's 15% faster and 20% cheaper than Oracle's best product. P&G would say, yes, And I will have to spend hundreds of millions of dollars and however many man hours ripping out what I have now, and my business will probably blow up when I do that. So the switching costs are very high. And so Oracle can raise price 2 to 3% every year. See this a lot with enterprise software companies. You also see it with data processors, people that integrate tightly with the customer's business. You can also sell an ongoing service relationship. So think of elevators. Once you have an elevator in a building, it probably ain't coming out again. And so you get elevator companies like Otis, which is part of United Technologies, Kohn, which is a Finnish company, Schindler, which is German. And their goal is to have a high, what's called attach rate, to attach a service contract to the elevator. Because once that elevator's in there, it ain't coming out again. And so you get this long service relationship. Rolls-Royce. Rolls-Royce typically sells its jet engines on what's called power by the hour. They actually sell it, and then you pay for it based on how much you use it. You don't just pay for it up front and then someone else maintains it. So that's a way of increasing the switching cost. And then you can provide a product with a very high benefit to cost ratio. Favorite example here is a company called Fastenal here in the US. If you have one bolt on your assembly line that goes down, and then you have a whole bunch of unionized guys standing around basically getting paid for not doing anything, you will pay a lot of money to get that bolt back on the line really quickly. And so that product doesn't have a very high economic cost in terms of how much you spend for the bolt, but has a huge benefit to your organization. Fuchs Petrolube, or Lubrizol, which Berkshire bought a while back, same thing, lubricants. If you have a lubricant that can increase the uptime of a giant mining machine down in a hole by 10%, so you don't have to take it down for maintenance as often, you don't have to take it apart and lube everything, and you get more productivity out of it, and that lubricant costs even 20% more than the competing lubricant, it's such a tiny cost of the overall part of the overall cost of running that machine, why not? So this high benefit cost ratio is really a cool thing to look for when you're looking for businesses with switching costs. You've got the network effect, which is simply providing a service that increases in value as the number of users expands. You can aggregate demand between fragmented parties. Think of distributors. Henry Schein is a dental distributor. So basically, most dentists are little owner-operators, 2, 3, 4, 5 dentists in a practice, and then they've got to buy stuff. They've got to buy those obnoxious cotton things that stick in your mouth and suck up the saliva and give you cotton mouth, literally. You've got to buy dental drills and all kinds of stuff. And basically, what they're doing is aggregating fragmented demand, fragmented supply, and they bring the two together and extract a lot of economic rents by doing that. One thing to watch for here is that one reason the network effect works so well is the nonlinearity of nodes versus connections. So if you have a web and you have the number of nodes in that web goes from 1 to 2 to 3 to 4, the number of connections increases exponentially. So that is something that makes it very hard to replicate a network once the network gains scale. Something that Googlers should be pretty familiar with, I think. One thing you want to watch for, though, is radial versus interactive networks. So the interactive network is what I just described, the web, where each node interacts with the other. A radial network is less valuable. So this was a good lesson I learned at Morningstar when we looked at Western Union. So Western Union sends a lot of, helps people send money from place to place. And they talk about, we have the most number of branches of any money transfer organization in the world, which is true. The problem is that no one is sending money from Bangladesh to Mexico City. They're sending money from Mexico City to Chicago, or from Mexico City to LA, or from Bangladesh to Chicago. We have a huge Bangladeshi community there. No one's sending money from Bangladesh to Mexico City or vice versa. So that route means nothing. So it's basically a series of channels, a series of spokes off different nodes that are easier for a competitor to pick off by underpricing service in that node. So radial networks are much, much less robust than interactive ones, we found. And then the final type of moat, cost advantages. This is kind of self-explanatory. But the thing is, there's a couple of differences here that you should look for when you're looking at companies. A process-based advantage is basically inventing a cheaper way to do something that is hard to replicate quickly. Southwest did this, Dell did this, Ryanair did this. Inditex, which owns the Zara brand, you may be familiar with, great example that everyone, they had the clothes made in Sri Lanka, the clothes made in Bangladesh because it was really cheap. But of course, because of transport links, you have to basically make a fashion bet 6 months in advance. What Inditex figured out was that if they nearshore it, if they get the stuff made in North Africa, get the stuff made in Eastern Europe, they could have much faster response times, much faster responses to different fashion trends. Now you can copy that, right? You can copy that, but it works pretty well while you're doing it. And so process-based cost advantages tend to work well, but then they get copied eventually. Southwest no longer has the lowest cost per available seat mile. People saw what they did and copied it. Scale, by contrast, when you spread your fixed costs over a large base, that tends to be much, much more robust. So think about this big network of brown UPS vans going around a neighborhood. What's the additional cost of putting one more package on the UPS van? De minimis, right? And so your margin on that is very, very high. Very difficult to compete. Good example, DHL, which is a wonderfully run business, has a very dense network in Europe. They lost over $1 billion trying to compete with UPS and FedEx in the ground market in the US. Couldn't do it, simply because they couldn't scale up. There weren't as many yellow vans as there were brown vans and blue and white vans. Scale-based advantages, especially in distribution, are incredibly robust. And you can have a niche where you establish minimum efficient scale. There are some niches, some industries, that can only profitably support one or two players. If another player comes in, spends the money to get in, returns come down so that nobody makes any money, so that new entrant never comes in the market. That can be, the businesses often can't grow very well because they're kind of trapped there, but they can be enormously profitable. So what about management? You notice I haven't said a word about management yet. There's a great quote from Warren Buffett that good jockeys will do well on good horses, but not on broken down nags. So this is a professional jockey on a goat. He is a very good manager. Sadly, he is on a bad vehicle called a goat. So if you enter this in a race, he's probably going to lose. By contrast, if you got me, and I don't even know how to ride a horse, as long as I don't fall off, I probably beat the goat. Because the horse is better suited for winning races than the goat. You're not going to get much milk out of it. The goat is better for that. But it's very well suited for winning races. So the key here is that you want to get a good horse. You want to look for good horses. It's not that the jockey is irrelevant. It's that even the best jockey, if he's on a goat, isn't going to make you a lot of money or win many races. Managers matter in the context of the moat. And the way to think about this is very simple. The required level of managerial skill is inversely related to the quality of the business. The worse the business, the better the manager. The better the business, as long as management isn't that stupid, you'll do fine. If it's a really bad business, you better have an awesome manager. This is Ryanair. O'Leary is an absolute genius. He's a jerk, and customers hate flying Ryanair, but he has created an amazing, amazing business. Ryanair is scale advantages to die for. By contrast, if you have a great business, genius is not needed. You saw where this was going, I know. He's actually, what that actually means is, here's what's happened to Microsoft's Moat while I've been in charge. It's an easy target here at Google, but it's true. I mean, Steve Ballmer essentially spent 12 years setting money on fire at Microsoft, as far as I can tell.
What do you think about Twitter?
Well, Twitter, never followed it much. And also that wasn't, no pun intended. The question was, what about Twitter? I haven't figured out what the monetization model is. I haven't figured out how they make money. I mean, they may have some secret theory. I just don't know what it is. But I haven't spent much time on it. Although I think it was founded by a guy named Dorsey, wasn't it? Anyway, I probably should look at it. So the key here is that moats can buffer management mistakes. Microsoft minted money despite Steve Ballmer. Despite them shoveling dirt in the moat every day, the core office, the core Windows franchises were strong enough that the business overall maintained pretty high returns on capital. New Coke didn't kill Coca-Cola because the business was robust enough, the brand is strong enough. Moody's put profits before integrity, actively screwed investors, and still cranked out a 40% operating margin. That's a pretty good moat. But even a genius like David Neeleman couldn't change the fact that JetBlue is an airline, which is the worst industry known to mankind. I mean, he's an amazing manager. If you've ever met him, read any of his books, seen him speak, he's incredible, he's inspirational. JetBlue was like 30-odd times earnings when it went public because it had leather seats and TV. I mean, an airline will never have lower costs than the day it opens for business. Why? Planes don't get newer, they get older. Employees don't get less seniority, they get more. So the planes cost more to run, the employees want more money. So the cost structure is inevitably bound to decline. Again, great jockey on a goat. Good managers are constantly looking for ways to widen a company's moat. Think about Amazon's focus on the customer experience. It's not so much about scale, it's about the customer experience. Here's a great, let me try this here. I've tried this at other talks around the world. How many of you have bought something off Amazon without checking the price elsewhere? Okay, that's like 2/3, 3/4 of the hands. Isn't that an amazing statistic right there? I mean, how hard is it to click to another website? What's the caloric cost of moving your mouse? It's not high, right? But I've talked to probably 45 CFA societies around the world. I get that's about the same number of hands that go up, except in Germany. The Germans didn't seem to, I mean, maybe Amazon hasn't done as well. Maybe Amazon has not been as, I mean, there's Zalando, there's a lot of other e-tailers there, but in the US, this is the response you get. And a lot of this is the customer experience, right? Trust matters more online than offline. And I give Amazon enormous credit for figuring this out early. That offline, in a regular physical store, I give you money, you give me a good, and we're finished. There's no trust involved. Online, I have to trust you send me what I ordered. I have to trust you don't steal my credit card number. I have to trust it arrives when you say it will. I have to trust you'll take it back if you say you will. There's a lot of trust involved. And that enabled the ability to build a moat, build a brand in retailing, which is a really tough industry to do that in. Think about Costco's focus on using scale to lower costs. Costco gets bigger, cost savings go right back to the customer. That brings in more customers, which allows more cost savings that go right back to the customer. That's what drives their business. That's all they think about every day. Now, by contrast, bad managers invest capital outside a company's moat, which lowers overall returns on capital. This process is called diversification, or setting fire to large piles of cash. Okay? This is basically what you don't want to see a company doing. Example, Cisco moving into consumer markets, the Netgear acquisition, I think it was. What on earth was that? You had this gorgeous, sticky business in enterprise, and you start selling consumer electronics that any moron just buys off the shelf at Circuit City? I mean, my set-top box at home used to be a Cisco, and I would just curse that thing every time I looked at it. Because it was just the worst business to go into. I mean, just fast product cycles, no competitive advantage. The whole network-centric home, so what? Remember Garmin? Anybody remember the Nuvi handset? No, nobody? Okay, so Garmin had this great franchise, partially in GPS devices in their car, but also a much better franchise in avionics. So your business jets, regional jets often have Garmin as the GPS device in there. You own a plane, you really want to know where you are. So that business this was a very good, sticky business. And so they see, oh gosh, GPS is going from a product to a feature. That's basically just a feature of a smartphone. Oh, let's not relax to the inevitable and just get out of the business. Let's double down and go into handsets and compete with Ericsson and Nokia. Completely moronic. And so again, you see investing outside the moat. You see a business do that out of weakness as opposed to out of strength when they're trying to maintain growth like Cisco did. It's a horrible sign. Yep, question.
How do you differentiate that from being innovative, like Google, for example?
Great question. No, I knew this was coming. So the question is, how do you differentiate that from being innovative? Because Google's doing it out of strength, right? Google's not doing it to preserve growth or because their core business is dying. Google's doing it as a way of planting seeds for hopefully a great business in the future. And that means a subtle difference, but it's coming out. The key thing is it's coming out of strength. Google's core business isn't going down. It's when you see a company's core business either slowing or the competitive advantage eroding, and they try to basically invest outside that to bump up growth. So, Cisco, one of the reasons they went into consumer electronics, Netgear, was to compensate for the fact that the enterprise market was slowing down. Or you can just say, hey guys, we'll grow at 6% and not 16 anymore. That would have been the more rational response. Instead, they go out and take a blowtorch to giant piles of cash by buying, remember the Flip? $800 million on this, basically a little video camera that will about 6 months later be in your phone. I mean, Again, out of weakness versus out of strength. Yep, another question.
How much of this kind of stupidity is correlated to the fact that these businesses that are sometimes wide moats are not run by owner-operators? You would imagine if you have an owner-operator, he would not.
Yeah. So the question is sort of how much of this stupidity is correlated to businesses that aren't run by owner-operators. I think it's a good. Well, John Chambers owned a decent chunk of Cisco, but I do think you see it less frequently with owner-operator businesses. You see it more frequently with businesses run by hired hands, where if the CEO leaves, he'll get a giant golden parachute, and he goes off and plays golf, and nobody's the worse off except the poor saps who owned the stock. So I think by having an owner-operator, you lessen this chance, but they're not infallible. The danger is when you have businesses that can't relax to change. And especially it's when you see this a lot actually with tech companies. No, not just tech companies, but companies when they mature. So this happened to McDonald's, it happened to Home Depot, happened to Starbucks, happened to Cisco, happened to Microsoft. As they get larger and have to go from being growth companies to being mature companies, they start continuing to act like teenagers when they're actually in their 50s. It's like the 50-year-old guy who's trying to date a 20-year-old. It's just inappropriate. And it's the same thing when you're a super successful business like Starbucks, when they just kept opening new stores. I remember there was a great Onion story once. Starbucks opened Starbucks in Starbucks bathroom, because they were just everywhere, right? And Howard Schultz came back and realized that the return on capital for these new stores was really not very high. And so the better way to allocate capital was not open crap loads of new stores. It was slow openings and focus on making more money, increasing ticket sizes, introducing food and so forth at existing stores. So, many businesses go through this transition. Sorry, we'll get the joker off the screen there. Now, there is, I should say, an exception to every rule about sort of management and the horse being more important than the jockey. There are a tiny minority of managers who can create enormous value via astute capital allocation, even if they don't start with great horses. Warren Buffett at Berkshire started with a textile mill, for God's sake. Brian Joffe at Bidvest, which is a South African firm, started with nothing. And now they do logistics, they do distribution, they do food service, amazing business. Dick Kovacevic at Wells Fargo, and banking is a tough business, really tough business. But what Kovacevic and Stumpf have done is nothing short of amazing. Stephen Mitchell at Danaher. Danaher's actually beaten Berkshire in the past 20 years in terms of shareholder returns. It started off selling industrial pumps, and they bought Beckman Coulter a few years ago, big diagnostics firm. So again, there is an exception to every rule. There is a tiny minority of managers that can make something out of not much. So keep an eye out for them. They're hard to find, false positives abound, but these guys can create enormous wealth over time. So just a kind of the sideline from the Moat conversation, but my point here, I don't want you to go out of here thinking management is irrelevant, because there is this tiny minority of guys that can just do amazing things. Yeah, there's a question there in the back.
I was wondering what's the role of chance in all of this? In the examples of products that are created, like new Coke, maybe they should not have done that and so on.
Yeah.
For every new Coke that did not work out, maybe there is another product by some other company that did work out.
Sadly, investing does not lend itself well to statistical proof, because you have individual examples where in highly skewed results, right? Where you have this huge long tail where a few companies do incredibly well and a very small number do okay. You probably would enjoy reading. There's a recent book by some, I think they're Deloitte, not McKinsey, Deloitte guys, called 3 Rules, where they did a pretty rigorous statistical analysis on returns on capital, and then went back and they did a whole bunch of did a bunch of pairwise analysis. They did a lot of controlling for industry factors to try to kind of eliminate the odds of luck happening with things, and looking sort of over what characteristics identified businesses that were likely to succeed over a long period of time. But there is a luck component to this, right? Example from Berkshire Hathaway. Warren Buffett, when early on, went to Washington, D.C. on the weekend to try to learn about insurance at Geico. He got the janitor. He basically banged on the door of Geico, and I can't remember the manager's name, but one of you Buffett nuts probably remembers, let him in and basically gave him like a 5-hour lesson on how to run and how to do insurance well. If that hadn't happened, Would he have really gotten the early tutelage in insurance and then created what Berkshire became? Maybe not. So no, again, my point here is simply, I don't want to, luck happens, right? Chance is part of it. But your choice is either say, this stuff is unknowable, and I'm just going to index, which is a completely rational thing to do, by the way. Or if we want to try to identify these businesses, we look for common characteristics that seem to have held up over long periods of time. But there is a role of chance in creating successful companies, and that's a weakness of like Good to Great, the Built to Last, and a lot of these success studies. That you would also enjoy a book called The Halo Effect, which really does a great job kind of basically disintegrating the idea of the hero CEO. It's a really good book. Yeah.
So you talked about two possible approaches. What about the third one, where we know for a large number of businesses, especially the majority of businesses, returns are going to revert to mean, and temporarily you can see certain businesses, the returns are extremely low, and maybe the valuation is even lower, and it kind of does not reflect the fact that maybe over time it will revert to mean, and maybe you can identify certain industry.
So these are the
Ben Graham type,
the crappy businesses that go to being semi-crappy.
Yeah.
I know what you mean. The businesses that are sort of low returns on capital that go up to the average. That's kind of traditional value investing, right? Sort of find the business that's priced as if it's going to go out of business, and if it survives, you do pretty well, right? Or it goes from a 2% margin business to a 5% margin business. That is a fine way to invest. Typically, these are not kind of moaty businesses. It's more what we call kind of cigar butt investing. Again, you can make plenty of money that way. It's not how I choose to invest, but plenty of people make lots of money that way. What I would say is the issue if you're going to pursue that approach is time is not your friend, because the intrinsic value of those businesses is declining over time. And if they don't turn around quickly, you're left with a declining asset. Whereas there's a great quote from Bob Goldfarb at the Sequoia Fund that time is the friend of the wonderful business, which is true because it builds value over time. And that becomes into sort of an additional margin of safety. So again, if you are going to go kind of for deep value, dumpster diving, you can make a lot of money, but just be aware that you may want to be aware of timing is all I'm saying, because what you're buying is probably declining in value. So just in a global context, I think it's important to remember local differences can create moats, okay? Foreign companies aren't allowed to own banks in Canada. Thus, the Canadian banks will always be insanely profitable, much more profitable than banks in almost any other part of the world. In Germany, this is a great one. Most German municipalities don't allow you to wash your car in your driveway or on the street because of environmental regulations. So car washing is actually a pretty good business in Germany because Germans like cars and you can't wash in your driveway, right? And so there's a pretty good business called WashTech that makes money basically providing all the consumables, the detergents and stuff, in car washes. This business could not exist in the US. So that's a local difference. So they can create moats. You also see minimum efficient scale being more common. So retailing is a tough business in the US. So it's a huge market, easy to come in. South African retailers have returns on capital that make Costco look like an airline. It's not entirely true, but they're great returns on capital. And the reason is simple. It's a relatively small market. And once you've got the 2 or 3 big players, it's really hard for anybody else to compete. And global players aren't going to come in because it's just not that big a market. Why am I going to bother spending a ton of money coming into South Africa? Walmart recently came in, but they just bought a local player. They didn't try to come in on themselves. Beck World is the largest producer of Thai language media. So, I mean, if you want to watch a soap opera in Thailand, a news broadcast, they own most of the pay TV channels. It's awesome business. I mean, Thailand's a big country. But Thai is not as commonly spoken as, say, English. So you're not minimum efficient scale. The odds that you have a competitor coming in there are lower than if you created, say, English language content. And then you also get cultural preferences. For example, beer travels. Beer can, often be exported. When I was in Macau last week, Carlsberg all over the place. It's a crappy beer. I don't know why, but Carlsberg seemed to be doing well there. Beer travels pretty well. Spirits travel pretty well. Candy and snacks don't. The snacks you grew up with, the candy you grew up with is what you will probably eat the rest of your life. You try to sell Hershey's in the UK, and they say it basically tastes like cardboard. Whereas Cadbury to most Americans is much too sweet. And like the Mexicans have this chocolate bar called Carlos Quinto, which basically is cardboard, as far as I can tell. Like the bar, actually, because they have to change the packaging in the US, it actually says chocolate style bar. It's like, craft and cheese product, But anyway, so these are cultural. Calbee. Calbee is a company in Japan that makes Japanese snacks that are never going to sell in the US. But Frito-Lay ain't going to sell much in China and Japan either. So these cultural differences can create moats in different countries. So why does all this matter? Why am I talking about moats? Who cares? Pretty simple. Moats add intrinsic value. A company that can compound cash flow for many years is simply worth more than a firm that can't. And you can think about this here simply with you've got returns on capital on the vertical axis, time on the horizontal axis. And for the no-moat business, returns on capital come down pretty fast as competition comes in. So there's less time for value to compound as you reinvest cash. For the wide moat business, you have longer span of time to reinvest capital at a high incremental rate of return. Now this brings up the question of valuing moats. And if you're looking at a business thinking about investing in a moaty company, the value is largely dependent on reinvestment opportunities. The ability to reinvest cash at a high incremental rate of return is a very valuable moat. If you can plow that cash back into the business, continue to take market share, expand your addressable market, you have a long runway ahead of you, that makes a business worth paying a pretty high multiple for. I think someone mentioned me, Whitney Tilson was here a while ago, said he didn't buy Google kind of early on because the PE was high. But Google had this opportunity to reinvest in the moat in a huge way. Fastenal has this. XPO, which is a logistics company that does truck brokerage, same thing. By contrast, if a firm has little ability to reinvest, the moat doesn't add much to intrinsic value. It adds certainty. It adds confidence. It narrows the range of possible outcomes. But it doesn't add much to the value because they can't reinvest. Think about McCormick. McCormick owns the spice market in the US. They own most of the private label spices you get from McCormick. Then they have the M-labeled ones that you see. But you know what? The consumption of turmeric is not going up 20% next year. Okay, not happening. All right. And so McCormick has to pay out most of the money. So that moat is valuable in creating stability and creating confidence. It doesn't really say I want to pay 30 times for this business because they can't reinvest it back in. Microsoft, Oracle, very similar things. The cash has to come out because they have nowhere to put it. And another important takeaway is that moats are not limited to these super stable companies your grandkids can own, the Warren Buffett inevitables. Those are a fairly small subset of the investable universe. And as I just mentioned, they have very limited reinvestment opportunities. Moaty businesses that pay out cash are good, but moaty businesses that can reinvest cash back in the business are truly awesome things. And when you can find those at reasonable valuations, it is very likely they'll make you a lot of money. And so when you think about investing in moats, the last takeaway I'll leave you is that overestimating the moat means you'll pay for value creation that never materializes. Underestimating the moat means you have a large opportunity cost. So let's look at a real cost example, Motorola. Okay, this is a chart of Motorola from 2003 to 2012. Remember the Razor? How many of you owned a Razor? Fair amount. How many of you owned a Razor 3 years later? And that would be nobody. Okay, exactly. So the Razor is released, right? And everybody goes bananas. And Motorola goes to 22% market share. And the market says, wow, this is fantastic. You got a moat. You got this great Razor franchise. It's a piece of hardware. There's no proprietary software. There's no switching cost. As soon as the next cool phone comes out, you go buy that, which is exactly what happened. And so we see what happens. Stock craters. Moat has 10% market share. People basically overestimated the value of the moat and got hosed on the stock because of that. Hosed is a technical term we use in the financial industry. Now there's an opportunity cost example in Walmart. So this is Walmart from about 95, 97 bananas to 99 through today. Buffett, and this is a story he told at the Berkshire meeting about 04, 06, they started to buy several million shares of Walmart back in 95. And it moved, and then he said, its prices moved up by 1/8. Let's wait a bit. Let's not buy anymore. You look what happened to the stock. Stock went from 10 to 50, right, basically. That decision, and this is a number he gave at the meeting, he said that what he called thumb sucking on Walmart, basically not buying enough, cost Berkshire $8 billion in money they could have made. And the reason was at that time they said, Walmart's a good retailer. They didn't say Walmart is an awesome retailer, and so we'll pay up a little bit for that. The point here being that when you find a truly awesome business, I mean, don't pay 100 times earnings, which is what Cisco was trading for in 1999, but you pay more. It's worth more. It's going to compound at a high rate because then you suffer opportunity cost. And most investors I've found spend a lot of time on margin of safety and not a lot on opportunity cost. And it's something to really think hard about, I think. And people often ask me, isn't the moat already priced in? We already know these are great businesses, right? Well, less often than you think, because most investors own securities for very short time periods. The average US mutual fund has turnover of about 100%. That's about a 1-year holding period. That's the average. There's plenty of folks who, 3 months is a long holding period. Moats matter in the long run, not the short run. Most investors also assume the current state of the world persists for longer than it really does. And so when things are tough for a great business, they say things will be tough forever, not that this moat will help the business bounce back. And finally, most investors focus on short-term changes in price, not long-term changes in moats. Because finding moats means finding inefficiency. What I found is that quantitative data in the market tends to be very efficiently priced. Qualitative insight, understanding the structural characteristics of the business, the switching costs, why do customers behave the way they do, why can this company raise prices a little bit every year, that tends to be less efficiently priced. Because, great quote from Bill Miller, all of the information is in the past, but all of the value is in the future. So the future value creation will often come from things you can see today, not necessarily the information that occurred in the past.